Real quick, let's talk about life insurance in general. Most people really don't understand life insurance. So this is Life Insurance 101. There are two types of life insurance basically. That's term and permanent. Term means there's a term, 10, 15, 20, or 30 years that you're covered. There's large coverages for minimum costs because it's a set period of time. And there's a return of premium option. What that means, if your premium is, say, $50 a month for 10 years, that is 120 payments of $50, which comes out to about $6,000. So at the end of your 10 years, if you didn't die, you receive a check for $6,000. Now, the other type is permanent. There's multiple different types of permanent insurance, but basically that's your entire life coverage. The coverage is more expensive because it does last your whole life, and payout is 100%. It's going to happen unless you miss a premium or a lapsed policy. These permanent policies can have cash value building properties, which means a portion of your money will actually go into a cash value account built within the policy, and it will build at the life insurance company's rate of return, which is normally 3 to 10%, depending on how the market does. Term life insurance is the most popular insurance. Here's an example, $500,000 in coverage for a 33-year-old male. 10 years, that's $37 per month. And as long as that policy is being funded with the $37 a month, your coverage still goes on. The pro is it's cheap coverage and a high face value. Face value is the $500,000. Con is you can lose coverage after 10 years. So all your money that went in is gone. You paid your premiums, you had your coverage, it's over. Now, permanent life insurance is different. Let's say you have a $500,000 coverage on a 33-year-old male. It does last your entire lifetime, and it's $410 per month in this example. The pro is the policy never ends, it's permanent. You have it your whole life. And if you die in a month or you die in 50 years, it's still going to pay out $500,000. And it builds cash value. We'll talk about cash value a little more in a second. But a con is it's expensive. Most people don't have $400 a month just to throw into insurance. And if the policy lapses, the cash value is taxable. So cash value life insurance, let's say you're paying $330 a month for a 33-year-old for 22 years, and then you stop making payments. If you have cash value life insurance, you have a bank account of $171,000 within this policy. So the payments from then on can come out of that cash value. You don't have to make payments anymore. Also, you can use it as a retirement vehicle. So say you have $171,000 and you pull out $17,000 per year for 25 years tax-free to either supplement or to be your retirement. Now, this can be fluctuated down to $100 a month or $30,000 a month, just depending on what kind of money you're working with and what you want your retirement to look like. And with this, you can retire early. Most IRAs and Roths, 401ks, you have to wait till you're 65 or you'll get a penalty to retire. In cash value life insurance, you can choose the date you retire depending on how much money you fund. The pro cash value life insurance, it's permanent, and you can have a tax-free retirement supplement. Con, it's expensive, and like I said, if the policy lapses, the cash value is now taxable. So your $171,000, you'd be taxed as capital gain tax. But that only happens in the early years, say years 1 through 7. After that, your cash value should be high enough that the rate of return will pay your insurance costs.